$94,050. That's the AGI ceiling for married couples filing jointly, below which your long-term capital gains are taxed at 0%. Not 15, not 5, 0. Most retirees fall below this line for at least a few years in retirement. Almost nobody uses it. In the next 10 minutes, I'll show you the 0% capital gains bracket nobody talks about. The math that lets a retiree harvest $100,000 of stock gains tax-free. The income stacking trick that pushes you out of the bracket without you noticing. The 4-year window most retirees ignore. And the magic sentence that locks it all in with your broker. There's a quiet moment about 6 months into retirement. The W-2 payroll income is gone. Social Security hasn't started yet. Pension is small. Your AGI for the year is the lowest it will ever be again. And sitting in your taxable brokerage account is years of appreciated stock you've been afraid to sell. The standard advice: hold forever. Step up basis at death. Let your heirs deal with it. The better advice: sell some of it right now at zero tax while you fit under the line. Today we fix that. 5 specific moves. Move 1. What the 0% bracket actually is. The IRS taxes long-term capital gains in 3 brackets: 0%, 15%, 20%. The brackets are based on your total taxable income, including the capital gain itself. For 2025, the thresholds: single filers, 0% on long-term capital gains up to $47,025 of taxable income. Married filing jointly, 0% up to $94,050. Above those thresholds, 15%. Above $518,000 for singles or $583,000 for couples, 20%. Critical detail: the bracket math uses taxable income, not gross income. Taxable income is your AGI minus the standard deduction. For a married couple 65 and older, the standard deduction in 2025 is roughly $33,700. So their AGI ceiling for the 0% bracket, $94,050 plus $33,700, $127,750 of gross income. Most retirees fall below this in their gap years. Move 2, the $100,000 tax-free harvest. Here's the math nobody runs. A couple in their gap year, 65, retired, not yet on Social Security, total income, $40,000 from pension, $20,000 from interest and dividends, AGI, $60,000. Subtract the standard deduction of $33,700. Taxable income, $26,300. They have $67,750 of room before they hit the 0% ceiling on long-term capital gains. They sell $100,000 of appreciated stock that has $50,000 of gain. The gain gets taxed at 0% because they're still under the line. Federal tax on the sale, 0. Not 0 withholding, not 0 today, 0 forever. Take Roger, retired Boeing engineer at 65, delayed Social Security to 70. During the gap years, his AGI ran about $55,000 a year, pension only. Roger had $90,000 of appreciated Boeing stock from his ESPP, basis only $20,000. He sold $25,000 a year for 4 years. Total gains harvested, $280,000 of stock with $70,000 of gain. Total federal tax paid, 0. Wait. Actually, he reset his basis to the new market value. The next year, he could sell more at 0 again. Move 3, the income stacking trick that ruins everything. Every dollar of ordinary income reduces the capital gains room dollar for dollar. So $1,000 of unexpected income, a $1,999 miscellaneous payment, a freelance gig, a small inheritance triggering distributions, eats into your 0 bracket capacity. The trap: most retirees don't realize the capital gain itself counts toward the taxable income calculation. If you sell $100,000 of stock with $60,000 of gain, that $60,000 gets added to your other taxable income for the bracket test. Cross the threshold by even $1, every additional dollar of gain shifts to 15%. Take Margaret, same Margaret, 68, sold $30,000 of appreciated stock. Gain of $20,000. Her other taxable income, $25,000. Total stacked taxable income for the bracket test, $45,000. Single filer ceiling, $47,000. Margaret had $2,000 of room left. She harvested at 0%. Margaret almost stacked accidentally. A $1,000 bank interest payment would have pushed her over and bumped her entire $20,000 gain into the 15% bracket. $3,000 of tax from one missed calculation. The fix. Run the full bracket math before any harvest. The brokerage calculator does not do this for you. Move 4. The 4-year gap window most retirees ignore. Between retirement and the start of Social Security plus RMDs, most retirees have 3 to 7 years of unusually low income. The 0% window opens widest during this period. Common pattern: retire at 63, delay Social Security to 70, RMDs start at 73. Window of low AGI, years 63 through 69. 7 years. In each of those 7 years, the couple can harvest as much appreciated stock as fits under the 94,050 bracket ceiling. The harvested gains reset the cost basis of the new shares purchased. So when they eventually do sell during higher income years, there's less embedded gain to tax. A couple who systematically uses every gap year can typically harvest 200,000 to 400,000 of long-term gain at 0%. Over a normal retirement, that's $20,000 to $60,000 of federal tax avoided entirely. The magic sentence for your financial planner. Quote, run a multi-year capital gains harvest plan that uses my full 0% bracket each year through the start of Social Security and RMDs, end quote. Move 5. State tax, the asterisk most miss. Federal capital gains rate of 0 does not mean state capital gains rate of 0. Most states tax capital gains as ordinary income. So even if you pay 0 federal tax on a harvest, your state may take 5 to 10% of the gain. The states that do not tax capital gains: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Wyoming, Washington, the retiree-friendly states, the states that hit capital gains hardest: California, up to 13.3%, New York, up to 10.9%, New Jersey, up to 10.75%. If you're planning a large harvest and live in a high-tax state, this is the year to weigh moving. The state savings on a $200,000 harvest can be $20,000. The federal savings is already locked in. The state savings is on the table only if you act. You've worked decades to build up that brokerage account. Most retirees pay 15% capital gains forever because nobody told them about the 0 bracket. 5 moves. Know the 0% ceiling. $94,050 for couples. Calculate your taxable income with the standard deduction. Watch the stacking trap. Use every gap year systematically. And consider state tax before harvesting. If even one of these saved you $1, hit subscribe. New videos every Tuesday and Friday. In the comments, tell me whether you're in the gap window right now. I rate everyone. I'll see you in the next one.